Okay. Okay. Good morning, everybody, and thank you for being here for the first broadcast of the series. And we're going to try to give you some information here that would be helpful on not only what's happening right now, but what we think could be some of the better ideas for 2022, which doesn't look like there's so many good ideas out there today, that's for sure. But I'm going to review some of the things that at optionprofessor.com we've been talking about and doing, and then you could take it from there. With regards to optionprofessor.com, I'm a graduate of Boston College and been in the investment arena for decades. Been educated at Chicago Board of Options Exchange and, of course, some of the major firms around. And again, we've done seminars throughout the country for decades, educating thousands and thousands of investors on the uses and risks of not only options, but investing in general. So again, we've got quite a bit of experience and knowledge, and we're going to share that with you. Everything that we talk about here, though, is our opinion, and it is not advice. So of course, you're always instructed to consult with your brokerage firm and your broker and your advisor and everybody else to determine your risk tolerance and also your suitability to do anything, because obviously we don't know that. But we will be giving our opinions and our observations again, but this is not advice to anybody. Okay, so let's talk about the S&P real quick, and I'll give you a little rundown on what we've been saying. This is a 20-year graph. So again, today we really wanted it to hold the 1-year moving average on the 20-year, which came in at 43. Where is it at? 43.28. We blew through that, so forget about that. And one of the reasons, I'll give you a couple of reasons why we thought it might blow through. Because if you look at QQQ, which is your NASDAQ, you'll see that it, it blew through it pretty well, right? So again, NASDAQ, the QQs would have to get above, I think it's 357 or something like that for it to get going, and that doesn't look like it's going on right now. And the other thing that the other index, the Russell, which we use IWM, this one also blew through it a long time ago, and it's testing down here. So on Russell, we'd be looking at this long-term average that comes in at 177 and this other one that comes in at 187 as potential points where it could slow down. And again, these highs here at the 170, again, would be another area of logical support. So again, this thing is discounted tremendously. What a false breakout that was, huh? And then it comes all the way down. I did want to add one other thing to the chart here before we get going too far, and that's the relative strength index. And on the relative strength, we tend to go with the 28 number rather than the 14 because we find it to be smoother and less spastic back and forth. And basically, we'll draw the chart with the RSI. So with the RSI, you can see that it's coming down towards the 50 number. It has not been pretty much under the 50 number, going back to 2010 almost. I mean, so if it comes down towards that 50 number area and we hold these areas on the Russell, this could be a tremendous buying opportunity for the second half of the year. Keep that in mind. That could be a very good thing to keep an eye on. Very discounted in price, coming into some support. RSI coming into some long-term support, because what you've got to do, in our view, our opinion, is you got to look at the longer-term charts when the shorter-term ones go bust. We're talking about Russell here, which is the small caps. I mean, this thing went short, up here at 240. Okay, so this thing's been negative for a while. And then if you look at the 5-year graph, this thing went bust at 220. So this thing's been negative for a while. So that's why we go to the long-term graphs to see if there's a net underneath this thing. And generally there is a net. And I would say that the net comes in at 170, 177 on a worst case. And then of course, 187 would be your best case right now. Okay. And your RSI again is still above 50. So it still has some room to go down further, but also it's in the lower echelon now from where it was. Let's go back to S&P because that's where most of you guys are sitting. Let's go back here to where we were. And we'll give you the S&P and give you an idea what that's showing. One more time. Okay. Now, this week, don't forget, you've got a couple of things going on as far as earnings, and the earnings will start tonight with IBM. Then it goes into other tech stocks like Microsoft on Tuesday, Tesla and Intel on Wednesday, and then the big kahuna is Apple on Thursday, and then you got the Fed meeting. So there is some things that could possibly stop the rain. But again, you have to have something to hold on to, and a lot of the moving averages that are broken, make it hard to do that. But here's your story here. Getting back above 43.27 would be a key right now for the S&P. If it did that, then you have something to defend at least at 43.27. So keep an eye on that, okay? And then, of course, you'll notice on the RSI here, where are you on RSI? We'll get that up in a second. But as we're doing that, again, try to keep an eye here on the S&P. And then you're looking at the 5-year graph again. There you'd have to get back above 44.76 to get back on the bicycle. And that's a long way from 43.07. Again, right now, the VIX was something that we told people about. When it gets above 20, that's a very concerning thing. When it gets above 25, school gets let out, which means what? When it gets above 20, you're getting a yellow flag that you're in a red zone, approaching a red zone. When you're above 25, you can fall into the abyss. If you get above 35 and 40, then you can have a March 2020 thing going on. Okay. So that's why you have to be very careful on, we look at the VIX very closely, simply because we don't want to get involved in such a declining situation without hedges on. One thing we have at Option Professors, we have an informational package on hedging that we send out. And you should have it if you don't have it already. It goes over everything from the covered calls, which is limited hedge, to going over collars, which has defined upside and downside parameters on your equity. We also go over married puts. I mean, some of you guys have had tremendous gains in these markets, and you could have thrown a little bit of that gain into an insurance put, and you'd be much happier today if you're seeing big drops in your equity. And then, of course, we have replacement trades. So that is where you get out of your stock and you replace it with a call spread or a call, which has limited risk. So if the bottom falls out, like we're seeing in many things now, you're in a situation where you have limited risk and the rest of your capital is out of the market. Now, I know everybody likes to badmouth money market and badmouth fixed income, but frankly, being in money market earning nothing is a heck of a lot better than getting wiped out in stocks. And that is where TINA doesn't make sense at some point, because going to cash, at least temporarily, can be a very, very effective tool. But again, people badmouth it so much, and the louder they badmouth it is probably the time when you want to do it. Again, when we're at 4,800 on the S&P and everybody says you're out of your mind to be in cash, out of your mind is looking pretty good right now. So, having been in it for decades, it's very apparent to us that you're looking at a situation, when things get very popular or very much out of favor, you've got to look at the other side of the trade, because again, it is a liquidity thing. When the markets are extremely high, there is a point where the buying does have an exhaustion. And if all those people want to come out at the same time, like we've seen lately, you have a liquidity crisis of an imbalance of sellers and buyers. Okay. So again, with regards to some things like the Russell I showed you, that could be going into the imbalance where the sellers will dry up at some point, and there could be an imbalance if the buyers come back in and there's no sellers, like we saw after March of 2020. Classic case of selling was so precipitous that when the buying came in and the Fed came in with their savior ideas, you got a situation where you got a tremendous order imbalance and the market snapped back dramatically. That again could be happening on a short-term basis here at some point. Again, if you want to take a look at the shorter term stuff, there's no indication of a turn at all. I mean, this is a 5-day graph. I mean, what would you do with this thing? Yes, it's oversold. Yes, it's far away from the averages. And yes, it could rebound rally if the news out of tech is good. And if the Fed, throw some cold water on this fire. But that is a very rough thing to step in front of here, because again, we haven't made any on a daily basis, even a low of which you can defend against. So again, the hedging techniques is something you should look into after the broadcast and find out. Get this package we have that explains all the different ways of hedging. So at least you know how to put some portfolio insurance on your accounts if in fact you think the rain is starting to come. You don't just have to stand there and get soaked. So again, but every strategy has a risk and a use. So you have to understand the use and the risk of the strategy and then make sure it's appropriate for your own situation. And again, you talk to your brokerage firm and your broker about that as well. But again, there's not much to report here. The only thing we can say is we use moving averages for a reason. And so on a 1 month basis is the first indicator of a good sell. And we got sell up here at a little under 4,800. And we got some more selling here at 4,700. So on a 1 month basis, this thing has been a good sell for a while. On the 1 year, this thing basically rolled over and said, I'm done around 46.50. So since 46.50, basically you should be out. On a 5 year basis, the thing broke on the 1 year at 4,600, at 45.50 again, and then at 44.75. So, it's been breaking down ever since. And even on a 20 year basis, the 1 year average is still, these are still rising. What that tells us is that we're still in a bull market, but this overbought condition that I talked about last year to everybody who would listen, that at some point you're going to revert back to the mean. And the mean starts here at 43.26, and the mean can be 3,800 and 3,500. Okay, so it's all according how far towards the mean you're going to go. But if you look in history, you revert to the mean all the time. You reverted to the mean here after the big run up after 2008. You reverted back. Up here in 2015-16, you reverted back. And then you reverted back here in 2018 when the Fed started to do their tapering. And then you reverted and cleared it during the crash of March. But notice when the moving average is still rising and it breaks the averages, but then jumps back above it, then you get back in, because again, the trend is still there. So I would want everyone to, on a longer term basis, to remember our view is as simple as this. The demographics of the US is we have an extremely large amount of 30 and 50-year-olds coming into play. People's biggest productivity and spending comes between 30 and 50. Buying houses, starting families, et cetera, et cetera. So our demographic is fantastic looking for the next 5 to 10 years. Also, real interest rates are still negative, which means you can't get ahead sitting in cash. So at some point, people will want to buy into something to make some money, and stocks are the best alternative versus a money market or a bond market that's negative. But when you have valuations up here and you have a Fed that added that much reserves to the system, who now must withdraw some of those reserves, you are looking at a situation where reverting back to the mean starts happening. And that's what's happening right now. But again, we want to take advantage of these big drops. And I'm going to show you some of the things that we would be looking at. Again, the FANG stocks and the mega cap, always something to take a look at. So let's take a look at Microsoft. And this is the longer term graphs. Again, it came down to the 1 year moving average, right? That's your first stop on reversion to the mean. So right now you'd like to see Microsoft stop at 282. And if you're a short-term trader and you want to be very, very aggressive, that is something to trade against. But the likelihood, since all the other 1 year averages have been penetrated, the likelihood that it may penetrate 282 is pretty high. So then you're looking at 240 and a little bit over 210. Looking at Apple, The second half of the year is supposed to be much different than the first. In other words, most of the trauma that we're seeing is supposed to occur between now and the first half of the year, Q1 and Q2. Q3 and 4 is supposed to be a better situation as we get closer to the election and a lot of this tapering stuff starts working through the system. Okay, so if you're looking at Apple, let's give you that. Apple still has a downside potential if it's going to revert to its 1-year average of 143. And then, of course, you're at 120 and change, and then 100 and change. Okay, if you look at the 5-year graph on Apple, you've already broken the 12 SMA. You're testing the 24 SMA, which comes in at 157. So and it's at 158. So some people might be trading it off of that number. And then the last one would be 150. That's on the 5-year graph. Okay. So again, these numbers we're seeing today are very important from the standpoint of trying to hold up. But if it does break, again, like Netflix really had a big drop, I don't think it's going to be like that, but going down towards 143 is not off the table if their earnings on Thursday do something. And again, let's talk about tech earnings. I was watching Bloomberg today, and tech earnings were growing at about a 40% clip in Q3 of last year. That's enormous. Q4 is expected to grow at 13%. That's a slowdown. Q2 and Q3 of this year, low single digits. That's a slowdown of growth. And then in Q4, they're looking for a jump of 12 to 13%. So again, back in the bicycle by the end of the year, but very rough racket in the first half and maybe even bleeding into Q3. But again, the market is always forward looking, right? And the reason it's been selling off is they are 6-month forward looking. So in January, you're looking out to June, and that's where these slowdown of growth rates in tech are anticipated. So that's why you're seeing people selling going into the next 6-month quadrant. When we are done with this sell-off, they're going to start looking at the next 6-month quadrant. And of course, that would include the end of the year where the earnings growth rate are supposed to be picking back up. So that gives you a little idea of what to look forward to. Now, again, one other thing people do sometimes during this type of environment, and let's throw up another one, Intel, which is announcing. Now, Intel, like I say, is not as crazily valued as the others. So you can see it is really just hanging around its moving averages. It's certainly underneath them, so that's not good. You'd rather see Intel trading at 65 or better if you want it to be bullish. So, 55 or better would be a better train to be on than here. And then, of course, the RSI is right there at the 50 number. So if you could get Intel above 55 and get going, even take out this high here of 56, and they are creating these factories in Ohio and Phoenix, reshoring something that we invented, which is the semiconductor here on our shores. Maybe this is something to keep an eye on as well. So keep an eye on Intel because it's not in that way overbought phase that the other ones are. And it does have some things going on that look like it could be positive for the firm looking forward. Let's look at Tesla. Now, Tesla, again, is going to be similar to, and again, this goes back 20 years. You can see it's got plenty of room on the downside. It's going down to test the 1 year, which is at around 800, 813. On a 5-year basis, Tesla's coming down and testing again this area here, which comes in at around 837. So 813, 837, those are big numbers, 800 right around there. So anywhere between 800 and 850, that's the kind of neighborhood you'd like this thing to stop. RSI is at 53 now. So if you're bullish on Tesla, 800 to 850 would be your neighborhood that you'd want it to hold. And then if you obviously thought it was a good price because it's $400 underneath at that point where it was, and $400 sounds like a lot. It's what is it? 25% off. This is the neighborhood where you have at least some price to defend against, 837 and 813. And again, you are buying it at a substantial discount to the high. With regards to Microsoft, we went over, and the other one announcing this week is IBM. Certainly not, doesn't seem like it's in the same league with the others, but, and again, some people have questioned some of their numbers, the veracity of their numbers. But again, on IBM, you know, on the longer term graph, you know, it is weakening and it is under 133 and 131. So this one you'd like to see above the 135 mark, and you'd like that RSI, which is at 47, to start getting above 50. If it doesn't do that, let's get this thing out of here so you can see. If it doesn't do that, then that would bode very well. And certainly if it starts taking out 120 and 115, this thing is going to probably go into the soup pretty heavy. So there you go on IBM. Let's look at the other big guys like Google. Because if people are going to go back into tech, it may be the large cap tech that they go into. Again, Google, again, this is why we use the moving averages. When it's up at 3,000 and you tell people it's going to go to 2,500 and revert to the mean, you know, people look at you like you have three heads, but that's exactly what it did. And that's exactly what we've been telling people. And in our packages that we send out, we've been warning people on that as well. So the bottom line is that's why you'd like to get the packages we have, because again, there's decades of knowledge in there and experience, and there's a lot of value to it. And we don't just go with whatever's going on. We go with where the puck might be going, not where the puck is located today. Okay, so anyway, here you go. That's the first level, 25.59, which it broke. Now, if it's going to go down and test the further ones, here you go. You'll have a shot at it at 20.39 or 17.76. That would be on a very, very significant drop. You know, we don't know exactly where things are going from the standpoint of the VIX. Again, it's above 30. If it starts getting into the 40s, again, that's where you can get what they call a acceleration, even more than we've already seen, to the downside. Above 25, acceleration to the downside. Above 35 and 40, that's when you go into kind of an abyss type thing. So you got to be careful. Watch that VIX. It's very helpful. I find it, obviously, I've been following it for decades. I find it very helpful. You know, you get down to 13, 14, 15 on the VIX, you know, it's probably not going to stay there. And again, when you jump up to 40, 50, 60 on the VIX, it's probably not going to stay there either. So those are pretty good extremes. All right. Again, so there you go with Alphabet. Again, getting back above 25.59 would be helpful. And if it got above there and you're a short-term trader, you know, then you might, you know, if you think there's a big bounce coming, getting above 25.59 would be key. And then either use today's low, which is 25.05, or use the moving average of 25.59 as an indicator. Okay, Amazon. This company has been not having the greatest time here, and it has really starting to give up the ship. Again, talk about reversion to the mean. You know, when it's up at 3,800 and we tell people, hey, the 1 year moving average is at 3,400, and underneath that, it's at around 3,000, and underneath that, it's 26.43. If it reverts back to the mean, that's where we're going. Do you think people don't look at you like you have two heads when you tell them Amazon might go down like that? Well, it's exactly what's going on here. And again, now you've got something to defend a little bit. Let's get this thing out of here again. Because now you're getting down to where the RSI is down towards 50, which is good. Still in a bullish mode. And you're getting down to where you have some places to defend, which is 26.43. And today's low is 27.70. So now you're 150 points away, which is a heck of a lot better than when it's up here. Okay. So these are the companies that, you know, people might be taking a look at: the Microsoft, the Amazon, the Tesla. What about Facebook or Metaverse? This is called, you know, mega cap tech. And this is FANGs and stuff like that. So here on a 20-year graph, it's already broken the 1 year. It's got support down here at 283 and 251. So those are two numbers to hold your hat onto a little bit. Looking at the 5-year graph, looks pretty lousy. And again, that's why when rallies occur now, you have a lot of overhead resistance because all these moving averages that were support for the last 5 years are now what? They're now resistance. So you got to be careful here about getting too excited. So that's what Facebook looks like. And that gives you a little bit of an idea. I'm going to go around the horn now to give you again, because again, when the 1 year and the 5 year break down, which they have, you then look to your longer term averages. And I'm going to go back, well, I'll go back at the end, but you saw on the S&P during the crash of March of 2020, we went through the long-term average, but the long-term average never went down. In other words, the direction of the moving average is very important. And if the direction is still rising and you get back above it, then the correction is more than likely over and you're back on the bicycle. So that's why I'm looking at the longer term graphs, because the shorter term graphs look like, trash, but they gave you sell signals, a long time ago in price. So they're really not of any great use right now because the sell signals, which were the good signals, have already come and gone. So now you're looking for, is there any place where this rain may stop? And that's why we look at the longer term graphs. Okay, so I'm going to go around the cycle here. Let's look at financials. Where would financials possibly do well? Okay, they're another one with a lot of room to revert back to the mean. It's getting tested right now. So this is a neighborhood where you'd want it to stop, which is 37. This is on the XLF. But if it breaks here, it's got downside potential to these numbers here, which is 30 and 31 and change. Okay. And your RSI is still very high. Look where your RSI is. RSI is still at 60. So you see what I'm saying? When your RSIs are high and the prices are high and the moving averages are low, this is what I talked about all last year. In fact, there's one gentleman who's an Elliott wave person who was giving indications a year ago that in 2022, we could get a very, very substantial low put in, a very, very substantial low, not unlike 1982, not unlike 1962, not unlike 1942. And if in fact cycle guys like that are accurate, we are going to get a very substantial opportunity, which has already started. But it is an opportunity to accumulate things because getting back to the big picture, our demographics of 30 to 50-year-olds is very, very high. And negative real returns on fixed income is not attractive to people that are trying to grow their wealth. So there'll be, again, good demand in the economy from these 30 to 50-year-olds, a lot of innovation, patents, et cetera, coming out of these people. And again, demand. And then the alternative of negative real yields is going to be a problem for people. And they're going to go back into the equity market because earnings will recover and demand will recover, and ergo stock prices should recover as well. That's the macro view for the next 5 to 10 years. Now you're going to get an opportunity this year to possibly position for that at a very attractive price. So that's what I would keep my eye on the ball here. Okay. But that ball is going to get pretty muddy and already has gotten pretty muddy before we hit that low in 2022, possibly. Okay. So again, there you go on your financials. It could stop here because that's the 1 year and it's still rising. What I'm trying to explain to you is this thing has been rising since 2011. So it's been a rising long-term moving average and it still is. So that's why, the belief here is that we have not lost the bull market. What we are is reverting back to the mean, which happens all the time in history, all the time. Okay. And sometimes you go beyond the mean because a pendulum swings, right? But it generally doesn't stop in the middle, which means the pendulum will go too far one way and then it'll swing back and go too far the other way, which is why here you go to 30 on the spider and then on the XLV, and then you go way through it. And now you've gone way above it and now you're going to go back toward it, and you may go through it, but this is a neighborhood that should be reasonable to hold up. And again, these are moving averages, so they get higher every day because you take out the old numbers and you put in the new, and the new numbers are very much above where we are. So these are moving averages, which means they are, as long as the market's up here, these averages will continue to rise, and that's bullish, technically. Okay, these other ones that people talk about, cyclicals, right? Value. Okay, well, here's our industrials. You know, this would be maybe your Boeing and your Honeywells and guys like that. Same story. Again, extended, holding on to the 1 year, but the risk is you're going to pull back to the deeper area over time. Materials. Now, materials are, you know, are getting hit pretty good. I'm going to give you a couple of them right now in a second to show. Same story. The whole market is saying the same story. The whole market went way up, and now the whole market is testing the 1 year. And if it breaks the 1 year and the unwinding gets sloppy, which has a better than 50-50 chance that we have a rough landing, then you're going to get it down here. You got to be prepared for that in some way, shape, or form. And that's where the hedging techniques would make sense, right? Put a little insurance in there. All right, that's the materials. Let me show you a couple of materials that have been giving it up. These are industrial metals I'm going to show you. And Freeport-McMoRan. I mean, this thing, I love this thing at $10, but it got to a point where you got to get out. Why? Because it's up here and the moving averages are way down here. So you got to be careful. Now it's testing the 1 year like everything else. And 1 year comes in at around, I think, around 38 and change. Where are you here? 37. Today's low is 37.85, and it's bouncing. So some people, you could trade off of that number. But the risk is that later on we may go deeper. But you got a number to trade against right here on the 1 year, which comes in at 37. But the history of the 1 year average on these other markets is not good. So you got to be careful. But again, you know, a guy who went in there and said, okay, I'm going to buy in at 37.70 or 72 where the low is today, and I'm going to put a stop underneath 37.19. You know, he's getting some action on his money today. A very gutsy call, but again, he had a reason to play it again that way because he had a moving average he was trading against. This one here, not as lucky, is Cleveland Cliffs. And this is more industrial metal. And this thing was the cat's meow on a lot of people, but now it broke through its 1 year big time when it broke through, and look at it's gone from 24 down to 16 here. So that's a pretty big drop. The averages now, the support comes in at 14 and 12.30. So at least it's a heck of a lot closer to the support zone. And the RSI is at 52. So this is not a bad neighborhood to start investigating CLF if you believe that infrastructure may pass and something will happen with the economy to keep these industrial metals going. But certainly they're a better value today than they were a week ago. And that gives you that. What about local banks, community banks? Well, here we look at KRE. And as you can see with KRE, there you go. Again, should be coming down to test this average here, which would be 67.80. And then if it breaks there and goes into the longer term stuff, it could go down towards 55. Again, when you see 55, remember in a week or two, if this thing is still up, these averages will be higher because they're moving averages and they are both rising. And there's your regional banks. If rates do go higher, that means they can charge more on their loans. And if money market's still at zero, you got the same game of we pay you nothing on your deposits, and now we charge you more on your loans and credit cards. And that's why the banks can make money in a rising environment sometimes, just as long as their loans don't go bad. And again, that's a risk when real estate has jumped 20 or 30% and people are taking out 90% loans. We've seen this movie before. We saw it in 1985, we saw it in 2008, and many other times. When people buy into an asset that is way up in price and they do heavy margin, meaning big mortgage, and that asset drops, well, let's do the math. If something goes for 100,000 and you put down 10%, 10 grand, and that asset goes down to 80,000, you're now negative equity 10,000. And if all your recourse is take the house back, then people move out, they leave the place trashed, and the bank now owns the house. And then if the real estate market gets bad, you got problems. Now, is that going to happen again? I don't know, but is the stage set for that? Well, what is the stage? The stage is A, excessively higher prices. I think we can all agree real estate's done that. B, a lot of loans with not much money down. I think they've gone into that game again. I don't know how far. I have to look into that. And then third thing is a correction where the houses correct. Why would they correct? Because mortgage rates go up, people's income, again, wage growth is negative because the increase in the wage has not been higher than the inflation rate. So that's negative wage growth. So you got negative wage growth. And now if you have a correction in the price, again, there's a problem that could be brewing there as well. I'm sure the Fed is very well aware of that, and they like to avoid that like the plague, but it's a risk. If that risk doesn't materialize and these guys can take in your deposits and loan out, they could make some good money. Now let's talk about another one that we've liked as far as a hiding out place is dividends. This is SPYD. And again, this one is got some support here at 40. But if you notice, it has been better than much of the rest of the market because people want dividends when they buy and of course, the dividends means the companies probably have good free cash flow. So this thing has come back down to an area where you would want it to hold. If it breaks underneath 40, that would be very, negative. And the RSI right now is down towards 50. So if people are going to hide out, meaning they're going to go someplace with their cash, if they go to a high dividend portfolio, they're dealing with companies with free cash flow, which is a good thing. They're dealing with a good income stream. So if something's not going well, at least you're getting checks, right? Dividends. And as long as they don't cut them or something like that. And then basically, this could be something that could be more stable. But again, it still has plenty of downside risk if it breaks underneath 40, because then you're down here into the 34, 36. But again, at least you're getting paid to watch a lousy movie. When you're in tech and you get no income and your principal's tanking, that's not very good. So that's called the dividend area. One of the other areas let's go over is we went over value is another one. Another place where people hide out, that and staples. So I'm going to show you those areas as well. Again, this thing is testing the 1 year, right? Still has downside potentials, very similar to dividend, same idea. Okay. But at least it's not like way up there like these other ones that have a lot of downside. Okay. And then the other one of value, and then staples. Okay, staples are extended, so they could get hit pretty good here down towards 70. But can you see that's where people are hanging out? They're hanging out here because this is Colgate, Palmolive, and Procter and Gamble, things that are staples that people buy, win, lose, or draw. And that's where people are more comfortable. So that's why we've been telling people about what? About dividends, about staples, and things like that, because that is going to be in a bad situation, less bad. Okay, let's go over a couple of other things before I run out of time. One is going to be international. And international in Europe, this is one that we've been focused on because we're a believer that Europe will be opening up this summer. The Omicron will roll over. People will come out of their homes. People in the US are going to want to have some fun, get back over to Europe. And we think there's going to be a good situation, particularly in the second half of the year, when the summer comes. So this is something that could benefit very well, because you saw how our banks did well when we came out for a while there, and how they have done, since the crash. So these guys are still, their book price to book is very, very, very low. So they've got good prices that way. The trend looks pretty good as long as you stay above 17, 18. Okay. And then on the RSI is, where is the RSI? So RSI is at 52. So this is something of very good value looking forward, because again, it's at 19 and going back towards 26 is a pretty good jump. Another one that is for Europe, VGK is a Vanguard. And this one again has broken, so it has downside potential if it's going to test the long-term averages. Okay. Again, this is not concentrated just in banks. There are some specific stocks we like in Europe, which we go over in our package. Then let's talk about the Pacific Rim. That's your Korea, and that is your Australia and your Japan. Okay, they're coming down into an area of support. Okay, so you want this one staying above 71 to 73. It's trading at 74. RSI is at 53. So between 70 and 74, that is a neighborhood, plus the RSI right around the 50 number. That is an area that we, in our package, we will explain why there could be some value here in the overseas market there. Another one would be in emerging market. Remember, China has already been nailed. Their prices are already down. And you know what? While we were printing $9 trillion zillion and exploding our money supply by 35%, China was not doing that. So they have got plenty of room to ease and add reserves to their system. And that could be interesting in the second half there. Now, in addition to China, I'll show you a couple of other emerging markets, but this is a one-stop shop. And you can see here that staying above the 45, 46 area is important, and the RSI is down in that low 50 area. So as long as it's above 50 and you're holding these numbers, there could be very good value in the overseas markets on emerging markets. Keep an eye on that one. Okay, now here's a few individual markets that I thought looked pretty good. Mexico, again, we are trying to get a little bit more close to home with all of our supply chains. And so rather than having them so far away, doing some of the work down in Mexico may be part of the reshoring type activity. That could be very good for these guys. So you can see that as long as we can stay above the 40 number, it could be a situation where there's value here longer term. And you can see that the RSI is at 50, 51. So it's coming into some support. So again, if we can maintain above the 40 area, 42 area, and even 45 area, there could be value to the Mexican shares. Another one is Brazil, which has gotten nailed. Let's take a look if there's anything there. Very big country, a lot of natural resources, but it's in trouble. And again, so this is one you'd stay away from because the RSI is what? Under 50, and it's under the averages. You start trading above 35 and 40 though, this could be a 1, 2, 3 formation where you hit a low, you came up here to 42, you pull back, you don't take out 20. And if you start taking out 40 and 42, this thing could start seeing way up here later in the year or next year as things change. So keep an eye on Brazil, because again, they've got a lot of natural resources down there, and natural resources obviously can come in very handy. So keep an eye on it. Not now, but things change. And if they change, don't forget about them. The other one is India, who's got also very, very strong demographics, like our own in some respects. And you can see these guys have gone from 20 all the way up to 50. They're pulling back. Again, the 1-year average on this one, 45. And then as long as you stay, if it reverts back to the mean, there's some of your worst case scenarios. So again, you get back down here, it might be something interesting. And with the RSI still at 60, there's a possibility you'll see it down here. But don't, throw the baby out with the bathwater. Be aware that the world will go on and that this is a country that may benefit in a longer term basis. Okay, last thing I want to get into before we have to close out is the precious metals. And I am going to show you the price of gold and some of the samplings of some of the stocks that we are looking at. Okay, so you are looking at gold here. Hold on here. Okay, give me a second here. I just made a mistake by hitting the wrong button for gold. Let's go and get continuous contract. Can I get? Yeah. All right, I'll get you the gold for April because obviously February's already here anyway. And you can see on the 20-year graph, it's in an apex, right? You really want to keep an eye on this one because again, if this is a wedge, if there ever was a wedge, and you got the one and the 12 and the 24 converging at what price? Right at 394 and 1790, 1794. So if it breaks under those levels, again, it may be able to get caught at the 1670 mark. If there's a big liquidity situation, it could break. But again, if it starts breaking above 1875 and 1900, this thing can spike out of here big time. So the RSI is right at what? Let's see. Right at 58. Okay, so it could have a break to the downside because RSI is a little bit elevated and be part of the sell-off that we're seeing. So it may be early to do it, but I'll show you a couple of stocks that might be interesting. The index of gold shares. Again, trying to hold on to this blue line, which it comes in at 31. It's underneath it. So a little bit more strength, And this could be an excellent thing to keep an eye on. If it starts getting above 34, 35, and it starts going, this thing could really run. So I'm watching this like a hawk, not ready to pull the trigger on it just yet, but I am looking at it very closely because if it does start taking off, there's a lot of real estate up here, a lot of real estate. Same thing with your silver. Again, holding up here, it's got to get above, this is on the silver miners, got to get above that 36. Again, looking at what? 48. So if this thing starts trading 38, 40, 42, it could be going someplace. On the 5-year graph, let's see. Again, this is why it's not been being able to hold its gains. It's down 6% because the trend is still down on this stuff. So the silver's a little bit early, and don't forget, silver is more of an industrial metal. So that's being drugged down like the copper and the Cleveland Cliffs. The gold is a different animal. We've got a group of stocks that are very interesting, though, and I'll just give you a taste of a couple of them here. One is called Goldfields. And take a look at this on a 20-year basis. That looks pretty good. You got a rising moving average coming in at $8. You've got what? The 12 and the 24 SMA are crossed and moving higher. The market is above the numbers and the RSI is at 55. So that is just an example of some of the stuff we put into the packages so that you could walk away with something. Because, I mean, let's be frank, if this thing does start taking out 12 and 14, and for whatever reason, because inflation is remaining high and the Fed's moving too slow because they want to go 1/4 of a point. I mean, people's talking about these 3 hikes. If it's 3 hikes at 0.25, the Fed funds is going to be 0.75 or 1% with inflation running 5 or 7. I mean, that's a joke. You know, I've been in this thing decades, so I have memory of Volcker. And the reason Volcker went nuts with the interest rates. I mean, we had a long bond at 16%. We had money market at 22%. I'm not suggesting that's happening again, but I am suggesting what led to that. I'll tell you, inflation went to 10% and the interest rate was at 5%. And that negative differential was extremely, and gold went from $190 up to $800. Okay. So the bottom line is to get that genie back in the bottle, the inflation genie. Volcker decided, it was decided that you'd have to hike rates very high to stop it. And there's a risk of that always when you get inflation very high like it is now. And again, it's in rents, it's in wages, it's in stuff that's not going to go away. You know, those guys who raised your rent, they're not going to lower your rent. If you got a raise, they're not going to take the raise away, especially with inflation, because your raise is actually no raise because it's not even keeping pace with inflation. So that's an example of what we are going over. And we have got a number of things in each package. So as I close up today, I want to invite you to go to optionprofessor.com, put in your information, and then maybe even if you want to email us, you could go optionprofessor@gmail.com and put your contact information. Let us know if you'd like income. Let us know if you'd like growth. Let us know if you'd like value and dividends. Let us know if you would like international. And then also let us know if you'd like some of the speculative ones, because we also have a lot of energy activity that we've done very well with. So we have packages that we put together and we make them available to you. So go to optionprofessor.com, put in your information. Better yet, go to optionprofessor@gmail.com, put in your information and your level of interest, and we can talk about how to get the package that we've put together. What we've done is we obviously are in this a long time. So we have a package of what? ETFs and individual stocks in each area. We even have a one-stop shop for commodities for people who want to diversify into that. But we have information we think adds value. And obviously, we want to make it available to you. So contact us through the website, optionprofessor.com, or email us, optionprofessor@gmail.com. Okay, thank you very much for being here, guys. There's other speakers coming up that are going to add a lot of value as well, I hope. And then, of course, I'll be back tomorrow at 10 a.m. Eastern time, and I'll go over more information at that time. This is Option Professor of optionprofessor.com signing off, and I'll give it back to David right now.